Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon, all. Ira Epstein with your agriculture update for this Wednesday, the 13th of September, 2017, just getting on to 1:45 p.m. Central Daylight Time. Interesting day because we have a strong bid in the dollar and weakness in the euro, weakness in the Canada, the British pound, and the yen. So the dollar's come up a bit. Interest rate futures have also dropped, which means rates have gone up. And we've seen stability in a number of the grain markets after getting whopped with a very, very bearish report yesterday out of the USDA. Now, the interesting thing on the USDA report is while the cotton went limit down yesterday and today came back and still closed 2 points lower, the last bids of the day, by the way, were about 20, 30 higher as they were getting into the final minute of settlement there. The government has said they don't know how much damage has been done to cotton, and even though their numbers are up, none of that takes into account Harvey, Hurricane Harvey or Irma. So things to remember. As for the other grains, we did not take out those August 31st lows. So have we seen a low in some of these grains? I think that's a big question mark that as market technicians, a lot of people are asking themselves. When we take a look at the weekly chart on beans, we're in a corrective mode. Haven't come down, taken out any important low, and I'd view the low that everybody's going to look at right here, this week's low, which was 921 3/4. Take that out, and I think you give the bears some ammunition. Don't take it out, and you've just thrown the kitchen sink at the market, and all you're down for the week is 3.5 points, and the bulls start coming alive on you. When we take a look at a daily area chart of closes, and it's an area chart because it's not showing highs and lows, it just takes the settlement price. It's now gone from 933 1/4 to 971, had a correction, it's coming back up. If yesterday's low is taken out on this of 950 1/2, you could then say that you're going into a down thrust. You'd have had a high, a rally back up, and then a lower close under the last break low. So that's what I don't want to see there. Now, when we just go to a bar chart, and the bar charts where you show, mine do at least, the open, the high, the low. We've gone from 921 to 977 1/2, corrected down near 936, and we've had a bounce back up with an inside day today. Okay, interesting. Rejecting some of the loss of yesterday, but in the process, do you see how these brown lines come together? What's happened now is you've got a pattern of higher lows and higher highs. It all turns negative if you take out 937 1/2. Why? Because you could end up, unless you went right through 77 1/2 tomorrow, of lower highs and a lower low. That would put the market into the bear camp. So, as somebody looking at a chart, I say the chart right now, trend is up. The number not to take out is 937 1/2. The market is doing what we discussed yesterday, that it came down yesterday, found its support against what? It left loose the day before from the 100-day average, falls yesterday down to the 18, and I said on the way back up, the resistance now could be that 100-day average, and you tell me what's going on. So now the big question is, after this, is the market able to eat into this? And if it gets over 77 1/2, I think you do this. Bye-bye. You got a market that's really saying all that news wasn't that terribly bearish. As we come over to the, let's take the Bollinger Bands. While you're at the 100-day and the 18-day average, the Bollinger Band's 973 3/4, the lower band's 924 3/4. The importance there is markets trade within those black bands 95% of the time. The first challenge of them to the upside or downside often uncovers either support, where a lot of professionals take money off the table, or resistance, where they take the same money off the table. So that's where you're at on those two numbers. In terms of momentum, you don't have it. What you've got here is momentum just sort of drifting. You have upside bias because the market closed over the 18-day average of closes. It's into the first level of resistance in price at the 100-day average. Should it be able to get through there, I'd look for the upper Bollinger Band. In terms of moving averages, if you take out this 937.5, you immediately target the lower Bollinger Band with momentum that will have turned down. So the key here is to turn the ship to the upside, and that's what momentum is trying to do. In the soy meal market, you've lost your way in the market. You've got a pattern of a lower low and a higher high. It looks to me as though you just want to trade sideways within this black band that's going pretty much sideways. And momentum, well, it hasn't turned up yet. As you can see, you still got the red line under the blue. It could turn up on a good day tomorrow. And just as easily, if the market starts down and takes out today's lows, you got to be careful. You already got lower high. That could give you, by taking out just today's low, you don't need that low, lower lows. Lower lows under the 18-day average. Momentum that's just trying to get neutral could turn down. So it's easier in the bean complex if you break through to the downside of yesterday's lows to let everything go down. In the soybean oil market, the market keeps drifting back a little bit here. Momentum down. Price action tried and up, actually closed lower. You don't have a trend. You got a higher high and a lower low, and a battleground is the 18-day average of closes. In plain English, it is not trending. When we come to the corn market, this is an important area. If the market can clear this 358 3/4, I think the bulls will say, hold on here. We had a shot to break through these lows. We failed on that yesterday. Get over those highs, and you might catch the people that went short into this covering, and maybe you can get to the upper Bollinger Band. But to get there, you got to get through these numbers, and guess what the pros are going to be doing? I believe they're going to be selling short right into the 18-day average, and I think they'll watch that 358 3/4, 359 level to see that it's not broken. If it gets broken, I think they become on the run, but I think the bears have control here. I mentioned yesterday I thought that the wheat market was getting super interesting, and why? Let's come back a little bit. Look at how these Bollinger Bands are coming together, sideways. Look at how momentum is drifting sideways. You can see this right through here. This was the action yesterday. This is today. So you went to the upper Bollinger Band, and from that number at 440, actually got to 449 3/4. That number is 447. The pros sold it right off from there, finishing the day down 3 3/4 lower. Now the market's in overbought condition against upper resistance. That doesn't mean the professional trader's still not going to nibble at the 18-day average, that 436 zone, but they don't want to see prices under 25 1/4. The problem is now in wheat, you have to break out of this pattern to get anything going, and it's probably going to happen, but in the process, you can sometimes get really chopped as the market's trying to do that. You can see how it tried to do it here as it narrowed, and you can see it right here. When it sets out on that, you often get big moves. So the question is, what's the next move going to be? In the sugar market, it's more of the same. It's just higher high, lower low, overbought condition. You keep pulling back to the 18-day average for support. The friendly part is the bias stays up because you're closing over the 18-day average. The negative is you're staying overbought, and you got resistance right above you at the 100-day average, and then slightly above that at 1456 at the Bollinger Band. Hard to do anything with the market that's churning like that. Now in the coffee, I want to go on record saying it's probably getting ahead of itself here. Now you've got 2 days in a row where you closed over the upper Bollinger Band. You are pulling the band out. And this is important to understand. When a band goes sideways, the only way you could yank it is having a market close over it. And yesterday you closed over it and went to the 100-day average and stopped. You see you're overbought. You see that the pattern is a lower low and a higher high. Okay. Today you added to that drama, and that's where you're at, but nothing has changed. That doesn't mean you can't go higher. It also means you're not trending in plain English. In the OJ market, OJ is fighting what battle? The upper Bollinger Band battle. We don't know how much damage. Just like in cotton, we don't know an awful lot just yet. We need people out in those fields telling us. But you get up over that band, you fall back under it. You're only going to stay over that band 5% of the time, and my rule of thumb is each successive day, and it takes away one of those percentage points. So we had 1, 2, let me come over here. As you can see on this one, the market closed back under the band. So you had 2 back under, yesterday back over, today back under. So you're not putting a lot of days in a row. But what happened here is very important. I want to show again. Do you see the sideways action? Sort of like we just showed in the wheat and some of the other markets. And here's the 100-day average. Eventually a market gets to it, and inevitably as it starts pushing on that band, it has to enter overbought territory. Here the market pulls back down. Now the market starts back up, and you're overbought, and the band is starting to widen. You've got to keep your eye on that because that's how bands widen. They inevitably widen. First, the market's got to become overbought, but you need successive moves pushing it out. You've done that. This market is not ready to just pull back in and go back to a pattern like that. That would take a bit of doing on the chart. In the cotton market, again, what I said, this market fell apart from 75.75 to today's low of 68.31. Momentum is down. Bias is down because you're under the 18-day average. Where do you think the first resistance is on the chart? I'm going to say the 100-day average of 70.66 and 70.64. If you sold the market there, where are you wrong? Well, if you're a pure chartist, you got to put a stop probably over the most recent high. Do you really want to risk $2,800 on a trade? I don't think so. And that's what it's saying to do. There are times when you just don't trade. Can't find a way to do it. Option trades, better ideas. In the cattle market, we're trying to turn the trend to the upside. Until today's low is taken out, now what you've done is you've got a pattern of higher lows, higher highs. You're in an uptrend. The target is 108.40 at this point, as long as momentum stays up. What don't you want to see on the chart? When you have an outside day up, you don't want to see that day's low, which is today's low, taken out either 2 days after that, within 2 days. So either on Thursday or Friday. Barring that, I'm looking for higher prices. And you're up at the upper Bollinger Band in an overbought condition in the feeder cattle already. Now, part of this has to do with low grain prices. You know, even though we can get a rally in the grains, these crops are big. They're not going to start a bull market from here. It's one thing to end the down phase. It's very different, in my opinion, to start something real bullish, and that's what's known there. In the hogs, you tell me what number the market's finally bouncing from. If you're going to keep breaking here, you know how I feel about Bollinger Bands, especially if you go back and you look. If the market gets down there, I contend the ones that are short, and I'll use the word short because you got lower highs, lower lows, you're in a bear trend under the market. If the momentum can carry down, it's down yesterday, my argument is when it hits the lower Bollinger Band, the odds favor the pros are going to short. I can't tell you that they're going to. I can tell you what I know and doing this 40 years and teaching it, and you got your bounce. Pretty simple. I want to remind you about option strategies. I mentioned them a minute ago, and probably one of the best sources you can get your hands on is the Chicago Mercantile Exchange. They wrote a book, 25 proven, not my word, their word, 25 proven option strategies. So what this helps you with is they give you the strategies and they give you an idea of what they do and when to use them. It'll give you an idea, are you just outright bullish? Do you think over time certain things are going to happen? Do you want to be short a call? Do you want to change the volatility of the market moving under you? This is a great book that they've put together. It's free. Give us a call. You go to our website, sign up for it, by the way. There's a carousel of free offers there. You can click right up here at any point in time if you're watching me on YouTube. And, of course, you can click under us on many websites. It says, click here for Ira's free offers. I'm Ira Epstein. You have a great day.